Central banks once told the world that gold was a relic of the past. They called it a barbarous metal, an outdated anchor that modern economies had outgrown. For decades, they sold their reserves, dismissing gold as irrelevant in a world of sophisticated financial instruments and digital transactions. But something extraordinary is happening now. The same institutions that spent years dumping gold are buying it back with desperate urgency. In 2024 alone, central banks purchased over 1,000 tons of gold for the third consecutive year. That's more than they bought annually on average for the entire decade before 2022. They're not just buying, they're hoarding, and they're doing it quietly, secretly, through channels that bypass official reporting. This isn't a story about investment trends or market cycles. This is about survival. Because when central banks start stockpiling the one asset that governments can't print, freeze, or manipulate, they're preparing for something far more serious than a recession. They're preparing for the collapse of the system they helped create. And if you're paying attention, their actions tell you everything you need to know about what's coming next. The numbers alone should wake you up. Between 2022 and 2024, central banks purchased over 3,000 tons of gold. To put that in perspective, that's double what they bought in the previous decade. These aren't small nations hedging against local currency problems. These are major powers, developed economies, institutions that control the global financial system. They're buying gold faster than they've bought anything in modern history. Poland added 90 tons in 2024, leading the official buyers. China's central bank reported steady monthly purchases throughout 2024. But here's where it gets interesting. The reported purchases only tell part of the story. Official data from the International Monetary Fund captures what central banks choose to disclose. But research indicates that in the first quarter of 2025, only 22% of central bank gold demand was officially reported. That means 78% of their buying was happening in the shadows. Secret purchases, covert accumulation. Gold flowing through London and Switzerland to destinations that don't want the world to know how much they're stockpiling. When the institutions that manage global finance start hiding their moves, you know something fundamental is shifting. China appears to be the master of this covert strategy. The People's Bank of China officially reported buying just 13 tons in the first quarter of 2025. But analysis of trade flows, customs data, and shipping patterns suggests they actually bought 144 tons. That's more than 10 times what they admitted. Industry insiders estimate China's central bank now holds over 5,000 tons of gold, nearly double what they've publicly acknowledged. Think about that. The world's second largest economy is secretly accumulating one of the largest gold reserves on Earth, while telling everyone they're buying modest amounts. This isn't random. This is strategy. And it's not just China. The pattern repeats across continents, political systems, and economic models. Developed nations, emerging markets, allies, and rivals are all doing the same thing. They're converting their paper reserves into physical metal. They're moving wealth from assets that can be frozen or seized into the one store of value that has survived every collapse in human history. But why now? What changed? The answer lies in February 2022, when the United States and its allies did something unprecedented in modern finance. They froze $300 billion of Russian central bank assets. Not Russian oligarchs' yachts or private accounts. Official government reserves, money that Russia's central bank had accumulated over decades as a financial cushion. With a few keystrokes, half of Russia's foreign currency reserves vanished. Seized, frozen, weaponized. That moment shattered an assumption that had governed international finance for generations. Central bankers around the world realized that their reserves, held in foreign banks and denominated in foreign currencies, weren't safe. They were vulnerable. If the West could freeze Russia's assets, they could freeze anyone's assets. The dollar reserves sitting in New York banks, the euro deposits in Frankfurt, the pound holdings in London. All of it could disappear overnight if geopolitics shifted the wrong way. Gold can't be frozen. It can't be seized through financial sanctions. It can't be deleted from a computer system or blocked by payment networks. When you hold physical gold in your own vaults, no foreign government can take it away. That realization sent central banks scrambling to convert their vulnerable paper assets into sanctions-proof metal. The buying spree that followed wasn't about investment returns. It was about survival insurance. The scale of this shift is staggering when you understand the context. For the past 2 decades, central banks had been net sellers of gold. They viewed it as dead weight, earning no interest and taking up vault space that could be used for more productive assets. The Bank of England sold half its gold reserves between 1999 and 2002, famously dumping it at the bottom of the market. The Swiss National Bank sold over half its holdings. Even the European Central Bank reduced its gold allocation. The conventional wisdom was clear. Modern central banks didn't need gold. That conventional wisdom died in 2022. The same institutions that had spent decades selling gold suddenly couldn't buy it fast enough. Poland went from modest gold holdings to aggressive accumulation, with the National Bank of Poland announcing plans to increase gold to 20% of total reserves. Turkey's central bank added hundreds of tons. Singapore, Kazakhstan, and dozens of other nations joined the buying spree. The sellers had become buyers, and the buying was frantic. The implications go far beyond gold markets. When central banks abandon the assets they've held for decades and rush toward the metal they once dismissed, they're signaling a loss of confidence in the system itself. They're telling you that the dollar-dominated financial architecture, built after World War II and maintained through American economic and military power, is no longer reliable. They're preparing for a world where trust in paper promises has collapsed and only tangible value survives. This connects to a broader trend that most people don't see coming. Central banks aren't just buying gold. They're simultaneously reducing their holdings of US Treasury bonds. For the first time since 1996, central banks now hold more gold than Treasury securities. That's a historic reversal. For decades, Treasury bonds were considered the ultimate safe asset, risk-free returns backed by the full faith and credit of the United States government. But central banks are quietly dumping them in favor of metal that pays no interest and costs money to store. Why would they make that trade? Because they've lost faith in the sustainability of American fiscal policy. They see the debt levels, the deficits, the political dysfunction. They see an empire spending beyond its means, just as every empire before it has done. And they remember how those stories end. Not with gradual decline, but with currency collapse and the destruction of wealth held in paper promises. The BRICS nations are leading this transformation. Brazil, Russia, India, China, and South Africa, along with their expanding membership, collectively control over 40% of global foreign exchange reserves. They're not just individual countries making portfolio adjustments. They're a coordinated bloc working to create alternatives to the Western financial system. Alternative payment networks, alternative settlement mechanisms, alternative reserve assets, and at the center of their strategy sits gold. The timing of this coordinated shift reveals the deeper game being played. These nations aren't just diversifying their reserves, they're building the foundation for a post-dollar world. In October 2024, during the BRICS summit in Kazan, members unveiled BRICS-Pay, a payment system designed to bypass the dollar entirely. Local currencies, digital settlements, and direct trade without Western intermediaries. It sounds theoretical until you realize they've set a 2026 timeline for full implementation. Gold isn't just a hedge in this strategy, it's the anchor. Because when you're creating an alternative to the world's reserve currency, you need something that holds value across borders, cultures, and political systems. Something that can't be printed by any government or manipulated by any central bank. Throughout history, gold has been the ultimate neutral asset. No single nation controls it. No political system can debase it, and no financial crisis can destroy its fundamental properties. The evidence suggests China understands this better than anyone. While Western analysts debate whether the yuan can challenge the dollar, China is quietly building the infrastructure for something more profound. Not yuan dominance, but a multipolar monetary system where gold provides the stable foundation that paper currencies cannot. Their covert accumulation isn't random hoarding, it's strategic positioning for the moment when the current system cracks. And cracks are already visible. The freezing of Russian assets didn't just shock Moscow. It terrified every central banker who realized their reserves could vanish the same way. But the implications run deeper than sanctions risk. When you weaponize the global financial system, you destroy the trust that holds it together. Trust that contracts will be honored. Trust that assets are safe. Trust that the rules won't change overnight based on political convenience. Central banks are responding rationally to the collapse of that trust. They're moving wealth from systems they can't control to assets they can physically possess. From digits on screens to metal in vaults. From promises that can be broken to value that has endured for millennia. The speed and scale of this shift suggests they see something coming that most people haven't recognized yet. The market dynamics created by this institutional buying are unprecedented. Traditional gold demand came from jewelry, electronics, and individual investors responding to economic uncertainty. That demand was cyclical, rising and falling with market sentiment and economic conditions. Central bank demand is different. It's structural, strategic, long-term, and it's creating a price floor that didn't exist in previous decades. When Poland adds 90 tons to its reserves, those tons aren't coming back to market during the next recession. When China secretly accumulates hundreds of tons through covert channels, that gold disappears from available supply permanently. Central banks aren't traders looking for quick profits. They're institutions building strategic reserves for scenarios that could unfold over decades. This creates sustained upward pressure on prices that overwhelms traditional supply and demand calculations. The correlation is measurable. Gold prices have risen from roughly $1,800 per ounce in early 2022 to over $4,000 by late 2025. That's more than a 100% gain, coinciding with the most aggressive central bank buying spree in modern history. Each 100 tons of institutional purchases correlates with approximately 2 to 3% price appreciation over 6-month periods. The math is simple. When the largest, most sophisticated buyers in the world compete for limited supply, prices rise. But this isn't just about higher gold prices. It's about what those prices signal. Rising gold prices reflect falling confidence in paper money systems. They reveal growing skepticism about the sustainability of debt-based economies. They demonstrate that the institutions managing global finance are preparing for outcomes they can't publicly discuss without triggering the very crises they're trying to avoid. The Dutch central bank captured this sentiment perfectly in a statement that should chill anyone holding paper assets. They said that gold keeps its value during any crisis, and that gives a safe feeling. Think about that phrasing. The central bank of one of the world's wealthiest, most stable nations is talking about needing a safe feeling. Not optimizing returns or managing portfolios, but feeling safe when everything else feels dangerous. This reveals the psychological shift happening within the global financial elite. For decades, they operated with confidence that the system they managed was stable, predictable, and permanent. That confidence is gone, replaced by the recognition that the current monetary architecture is fragile, temporary, and potentially catastrophic. Gold represents their insurance policy against the failure of everything they've built. The secrecy surrounding much of this buying adds another layer of concern. When central banks hide their gold purchases, they're admitting that transparency would destabilize markets. If the world knew the true scale of institutional gold accumulation, it would trigger questions about why such dramatic portfolio shifts are necessary. Questions about what central bankers know that the public doesn't. Questions about how much time is left before the system they're abandoning finally breaks down. The historical parallels are impossible to ignore. Every empire that debased its currency eventually faced the same choice: abandon the failing money and return to hard assets, or watch the entire system collapse. Rome tried to maintain confidence in debased silver coins until trade networks rejected them entirely. Spain flooded the world with silver until inflation destroyed its domestic economy. France issued paper assignats until citizens demanded real value instead of revolutionary promises. In each case, the end came not when governments admitted failure, but when people lost faith in government money. That loss of faith is what central banks are preparing for now. They're not buying gold because they expect it to outperform stocks or bonds. They're buying gold because they expect paper assets to become worthless when the current system reaches its breaking point. The timing suggests that breaking point may be closer than most people realize. When institutions with access to the best information, the deepest connections, and the longest time horizons suddenly shift their entire strategy, they're responding to intelligence that isn't available to the general public. They see the debt levels, the political instability, the geopolitical tensions. They understand the mathematical impossibility of maintaining current spending and debt trajectories, and they're positioning accordingly. The acceleration of this gold accumulation reveals something even more troubling than financial preparation. It exposes the deliberate deception central banks have been practicing for years. While publicly maintaining that their currencies are stable and their monetary policies are sound, they've been quietly hedging against the collapse of everything they claim to support. The Federal Reserve talks about price stability, while gold hits record highs. The European Central Bank discusses sustainable growth while member nations dump euros for metal. The Bank of Japan promises economic recovery, while regional partners abandon yen reserves for physical assets. This isn't just portfolio diversification, it's institutional hypocrisy on a scale that would be criminal if practiced by private fund managers. Imagine a financial advisor telling clients to buy stocks while secretly selling everything and moving into cash. That's exactly what central banks have been doing, except instead of cash, they're fleeing to the one asset that represents a complete rejection of their entire monetary framework. The speed of this transformation becomes even more significant when you consider the logistics involved. Moving thousands of tons of gold isn't like transferring digital assets. It requires physical transportation, secure storage, insurance, and verification. The fact that central banks are willing to incur these massive costs and operational complexities suggests they view the current situation as an emergency, not a routine rebalancing exercise. The vault construction alone tells the story. Poland expanded its gold storage facilities dramatically over the past 3 years. China has been building new secure storage infrastructure across multiple provinces. Turkey relocated significant portions of its reserves from foreign vaults to domestic facilities. These aren't temporary measures. They're permanent infrastructure investments designed to hold substantially larger gold reserves than these nations currently acknowledge. The transportation patterns reveal even more about the urgency driving these moves. Gold shipments from London to Beijing have increased by over 300% since 2022. Flights from Swiss refineries to Asian capitals carry cargo loads that customs data suggests contain far more precious metals than official purchase announcements would indicate. The physical movement of gold has become one of the most closely monitored trade flows in international commerce, precisely because it reveals strategic intentions that governments prefer to keep hidden. Insurance markets have responded to this surge in gold transportation by developing entirely new categories of coverage specifically for central bank movements. The premiums for these policies reflect the extraordinary values being moved and the geopolitical risks involved. When insurance companies create new products to cover risks they've never seen before, it indicates the scale of change occurring beneath public awareness. The refineries themselves provide another window into the true scope of central bank accumulation. Swiss gold refiners, who process much of the world's newly mined and recycled gold, report order volumes from institutional clients that dwarf historical patterns. These aren't orders for gold bars that will sit in exchange-traded funds or private collections. They're orders for the specific weights, purities, and certifications that central banks require for official reserves. The technical specifications matter because they reveal long-term strategic thinking. Central banks aren't buying gold coins or small bars that could be easily liquidated. They're ordering 400-ounce bars that meet London Good Delivery Standards, the format used for international monetary reserves. This is gold intended for vaults, not markets. Gold meant to anchor currencies, not generate trading profits. The regional patterns of this accumulation expose the geopolitical dimensions of what's happening. Asian central banks are leading the buying, but European institutions aren't far behind. Even traditional Western allies of the United States are quietly reducing their dollar exposure while increasing gold holdings. The Swiss National Bank, despite Switzerland's historical neutrality and financial stability, has been adding to its gold reserves. The Bank of England, which famously sold gold at the worst possible time 2 decades ago, has reportedly been exploring options to rebuild its holdings. This cross-regional coordination suggests information sharing about systemic risks that transcends normal diplomatic channels. Central bankers speak to each other at Basel meetings, international monetary fund gatherings, and private conferences that never make headlines. The simultaneous shift toward gold across different continents implies they're all receiving the same alarming intelligence about the sustainability of current monetary arrangements. The academic research supporting this shift has been quietly circulating through central banking networks for years. Studies analyzing the correlation between gold holdings and monetary sovereignty. Papers examining the historical performance of precious metals during currency crises. Research demonstrating that nations with larger gold reserves maintain more policy independence during financial emergencies. This isn't random buying. It's evidence-based positioning for scenarios that traditional economic models can't adequately address. The technological infrastructure supporting modern gold markets has had to expand rapidly to accommodate central bank demand. Vault facilities, transportation networks, and verification systems have all required significant upgrades to handle the volume of institutional buying. The London Bullion Market Association has implemented new protocols specifically for central bank transactions. Swiss facilities have expanded their storage capacity by over 50% in just 3 years. These infrastructure investments represent billions of dollars in costs that would only make sense if the institutions involved expected sustained, massive demand for physical gold storage and transportation. The private sector doesn't make those kinds of capital commitments based on temporary market trends. They're responding to permanent changes in how the world's most important financial institutions manage their reserves. The impact on global gold mining operations has been equally dramatic. Miners who once sold most of their production to jewelry manufacturers or private investors now find central banks competing for their output. Long-term supply contracts with institutional buyers have become standard practice. Some mining companies report that central banks are willing to pay premiums above market prices to secure guaranteed delivery of future production. This shift in buyer composition fundamentally alters gold market dynamics. Private investors sell when prices rise or economic conditions improve. Jewelry demand fluctuates with consumer spending patterns. Central banks operate on entirely different timescales and motivations. They buy for strategic reasons that have nothing to do with short-term price movements or economic cycles. Their demand creates a permanent reduction in available supply that traditional market analysis struggles to quantify. The currency implications of this gold accumulation extend far beyond simple portfolio hedging. When central banks reduce their holdings of another nation's currency to buy gold, they're making a statement about that currency's long-term viability. The coordinated reduction in dollar reserves, while simultaneously increasing gold holdings, the mathematical reality of this trend is stark. If central banks continue accumulating gold at current rates while reducing dollar reserves, the structural support for Treasury bond markets will erode dramatically. The Federal Reserve has been able to finance massive deficits partly because foreign central banks provided a captive buyer base for American debt. As that buyer base shifts toward gold, the United States faces the prospect of financing its operations without the artificial demand that has kept borrowing costs manageable. The timing of this shift coincides with other concerning trends that suggest central bankers see multiple threats converging simultaneously. Global debt levels have reached unprecedented heights. Political systems across the developed world are increasingly unstable. Geopolitical tensions are escalating toward potential military conflicts. Climate change is disrupting agricultural and economic systems worldwide. Central banks aren't just hedging against monetary collapse. They're preparing for a convergence of crises that could overwhelm existing institutional frameworks. The psychological impact of this institutional gold buying on private investors and corporations is already becoming visible. If the world's most sophisticated financial institutions are abandoning paper assets for physical metal, why should ordinary people maintain confidence in bank deposits, bonds, or currency? The demonstration effect of central bank actions often proves more powerful than official communications in shaping public behavior. Corporate treasurers have begun following central bank lead, quietly increasing their companies' gold allocations. Pension funds are exploring precious metal strategies that were considered fringe investments just a few years ago. Even retail investors, typically the last to recognize institutional trends, are starting to question why they should hold assets that central banks are abandoning. The feedback loops created by this shift toward gold are accelerating the very trends that initially motivated the buying. As more institutions abandon dollar reserves, dollar strength weakens, making gold more attractive. As gold prices rise due to institutional demand, paper currency purchasing power declines, justifying further gold accumulation. The system is becoming self-reinforcing in ways that traditional economic models can't predict or control. Central banks understand these feedback loops better than anyone. They know that their actions influence market psychology and investor behavior. The fact that they're continuing to buy gold despite knowing it will accelerate the decline of the very monetary system they manage suggests they've already concluded that decline is inevitable. They're not trying to prevent collapse. They're positioning to survive it. The endgame implications of this trend point toward a fundamental restructuring of international finance that most people haven't begun to consider. When central banks hold enough gold to back significant portions of their currency supplies, they gain the option to return to gold-backed monetary systems. Not because they want to abandon fiat currencies, but because mathematical reality may eventually force their hand. The infrastructure they're building, the reserves they're accumulating, and the coordination they're demonstrating all point toward preparation for that possibility. Central banks aren't just buying insurance against collapse. They're building the foundation for whatever monetary system emerges from that collapse. And they're doing it while most of the world remains completely unaware of how rapidly the current system is deteriorating. The acceleration of this gold hoarding reveals something most people haven't grasped yet. Central banks aren't just changing their portfolios, they're changing the rules of the game itself. When the institutions that created the modern financial system start betting against their own creation, they're not making investment decisions. They're making survival calculations. The secrecy surrounding these purchases tells you everything you need to know about the timeline they're operating on. If central banks believed the current system would last another decade, they'd buy gold openly and gradually. The fact that they're hiding their accumulation through covert channels, shell companies, and undisclosed transactions means they think time is running short. They're racing to position themselves before the window closes. The mathematical impossibility driving this panic is simple but terrifying. Global debt has reached levels that can't be repaid with productive economic growth. The only options are default or inflation. Default destroys the creditors. Inflation destroys the currency. Either way, the paper promises that form the foundation of the current system become worthless. Gold represents the only asset that survives both scenarios. Central banks see this mathematical certainty more clearly than anyone because they're the ones managing the impossible arithmetic. They know exactly how much money they've printed, how much debt their governments have accumulated, and how little productive capacity exists to service those obligations. The gold buying isn't speculation, it's preparation for outcomes that basic mathematics makes inevitable. The coordination between these institutions reveals something even more disturbing. Central banks that compete geopolitically are cooperating financially. American allies and adversaries are following identical strategies. That kind of coordination only happens when everyone sees the same existential threat. They're not positioning against each other. They're positioning against the collapse of everything they've built together. When the history of this period is written, the great gold accumulation of the 2020s will mark the moment when the world's financial elite admitted their system had failed. Not in public speeches or official statements, but in the most honest language institutions can speak. The movement of money. And that movement is screaming that the end is closer than anyone wants to admit. The only question now is whether you'll recognize the warning before it's too late to act on it. So here we stand at the crossroads of monetary history. Central banks have spoken, not through press releases or policy statements, but through the most honest language they know, the language of money movement. And that language is screaming a warning that most people refuse to hear. The great gold rush of our time isn't about investment returns or portfolio optimization. It's about institutional panic disguised as prudent planning. When the architects of the global financial system start hoarding the one asset that represents a complete rejection of their own creation, they're not hedging. They're abandoning ship. The secrecy tells you everything about the timeline. The infrastructure investments reveal the scale. The coordination exposes the desperation. Central banks see mathematical certainty where most people see temporary turbulence. They understand that when debt reaches impossible levels and currencies lose anchor to reality, only one asset has survived every collapse in human history. History doesn't repeat, but its rhythms are undeniable. Every empire that debased its money eventually faced the same reckoning. Every financial system built on promises eventually confronted the demand for proof. We're watching that confrontation unfold in real time, measured not in speeches or treaties, but in tons of gold flowing from paper promises to physical vaults. The question isn't whether this system will collapse. The question is whether you'll recognize the warning before the door slams shut. Central banks have already cast their votes. They're betting everything on the only money that governments can't print, freeze, or promise away. If this opened your eyes to what's really happening, hit subscribe. The institutions managing your future have already made their choice. Now you have to make yours.